Hey everyone. Today I want to dive into a topic that's crucial for building long-term wealth investing in the stock market. Whether you're just starting or have been investing for a while, there's always something new to learn. Now, I know the stock market can seem intimidating, especially with all the financial jargon and constantly changing numbers, but trust me, it's not as complicated as it seems. We'll cover everything from what the stock market is to how to choose your first stocks. So, what exactly is the stock market? In simple terms, it's like a giant online auction where you can buy and sell pieces of companies called stocks or shares. Think of it this way. Imagine your favorite company, let's say Apple. When you buy a share of Apple stock, you're essentially buying a tiny piece of ownership in that company. And just like any other investment, the value of your Apple stock can go up or down depending on how well the company performs and other factors. There are different stock exchanges where these trades happen, like the New York Stock Exchange or the Nasdaq, but the basic idea is the same. Buyers and sellers come together to trade stocks based on their perceived value. The stock market can be volatile, meaning prices can fluctuate a lot in the short term. Instead of trying to time the market, focus on finding solid companies with good long-term growth potential. By investing consistently over time, you give your investments the opportunity to grow and compound, potentially leading to significant wealth down the road. Now, you might be wondering, why invest in stocks at all? Why not just keep your money safe in a savings account? Well, while savings accounts offer stability, the returns are often very low. Historically, stocks have outperformed other asset classes like bonds or real estate over the long term. This means that while investing in stocks does come with some level of risk, the potential rewards can be much higher. When you invest in a company that grows and becomes more profitable, the value of your investment grows along with it, and as that company continues to succeed, it might even start paying out dividends, providing you with a passive income stream. Of course, investing in stocks is not a guaranteed path to riches, but by understanding the fundamentals of investing, diversifying your portfolio, and investing for the long term, you can significantly increase your chances of success. Now, let's talk about two different approaches to investing: short-term and long-term investing. Short-term investing, or trading, is like sprinting. It's fast-paced, risky, and requires a lot of skill and attention. Traders try to capitalize on short-term price fluctuations in the market, buying low and selling high, hoping to make a quick profit. However, this approach can be incredibly stressful and often leads to more losses than gains, especially for beginner investors. Long-term investing, on the other hand, is like running a marathon. It's about patience, consistency, and focusing on the bigger picture. Long-term investors look for solid companies with strong fundamentals and hold on to their investments for years, if not decades. By adopting a long-term mindset, you ride out the market's ups and downs and focus on the overall growth potential of your investments. Now, I'm not saying that short-term trading is always a bad idea. If you have a deep understanding of the market, a high risk tolerance, and the time to dedicate to constantly monitoring your investments, it can be a viable strategy. But for most people, especially beginners, long-term investing is the way to go. Remember, investing is not about getting rich quick. It's about building wealth gradually over time. Chapter 4: Diversification. Now let's talk about one of the most important concepts in investing: diversification. Imagine you put all your eggs in one basket and then you drop the basket. What happens? You guessed it, all your eggs break and you're left with nothing. The same principle applies to investing. If you put all your money into one stock, one industry, or even one asset class, you're putting yourself at a huge risk. If that one investment doesn't perform well, your entire portfolio could suffer. That's where diversification comes in. By spreading your investments across different assets, you're essentially creating a safety net for your portfolio. If one investment goes down, the others can help cushion the blow. Think of it like building a well-balanced meal. You wouldn't just eat one type of food all the time, right? You need a variety of nutrients to stay healthy. Similarly, your portfolio needs a diverse mix of investments to thrive. So how do you diversify? First, consider investing in different sectors or industries. Don't put all your money into tech stocks, for example. Spread it out across other sectors like healthcare, consumer goods, or energy. Second, think about investing in different asset classes altogether. Stocks are just one piece of the puzzle. You could also consider investing in bonds, real estate, or even commodities like gold or oil. The key is to create a portfolio that aligns with your risk tolerance, time horizon, and financial goals. Chapter 5. Risk and Reward. In the world of investing, there's a fundamental principle that always holds true. The higher the potential reward, the higher the risk. It's like climbing a mountain. The higher you climb, the more breathtaking the view, but the riskier the climb becomes. Stocks are no different. Some stocks, like those of small, rapidly growing companies, have the potential for explosive growth, but they also come with a higher risk of volatility and even failure. On the other hand, stocks of well-established blue-chip companies tend to be more stable and less volatile, but their growth potential might be more limited. So how do you find the right balance between risk and reward? It all comes down to your individual risk tolerance. Are you comfortable with the possibility of seeing your investments fluctuate significantly in value, or do you prefer a more conservative approach? There's no right or wrong answer here. If you're younger and have a longer time horizon, you might be more comfortable taking on more risk, knowing that you have more time to recover from any potential losses. If you're closer to retirement, you might prefer a more conservative approach, focusing on preserving your capital and generating income. The key is to be honest with yourself about your risk tolerance and invest accordingly. Chapter 6. Start small and stay consistent. Now, you might be thinking, this all sounds great, but I don't have a lot of money to invest. And you know what? That's perfectly okay. You don't need to be wealthy to start investing. In fact, many online platforms allow you to start investing with as little as $100 or even less. The most important thing is to start somewhere, no matter how small. Remember, investing is a marathon, not a sprint. The key is to be consistent over time. One of the best ways to do this is through a strategy called dollar cost averaging. Dollar cost averaging simply means investing a fixed amount of money at regular intervals, regardless of the market conditions. This way, you're buying more shares when prices are low and fewer shares when prices are high, averaging out your cost basis over time. Think of it like buying gasoline for your car. You wouldn't wait for the price of gas to hit rock bottom before filling up your tank, would you? You fill it up regularly regardless of the price. Investing is similar. By investing consistently, you're essentially filling up your portfolio and taking advantage of market fluctuations over time. The beauty of dollar cost averaging is that it takes the emotion out of investing. You're not trying to time the market or predict when prices will go up or down. So, to wrap things up, investing in the stock market can be one of the best ways to grow your wealth over time. Remember, it's not about getting rich overnight, but making smart, long-term decisions that pay off in the future. With a little bit of knowledge, a solid plan, and the discipline to stay the course, anyone can achieve their financial goals through the power of investing. Let me know if you have any questions or need help getting started with your investment journey.